All right. Today is Thursday, the 2nd of February. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Let's start by this. The brainless zombie rally continues. Let's just buy everything, something, anything, because we created this fantasy in our heads that, inflation is dead and the economy is going to survive and land in a soft landing. Everything is going to be all right. And by the way, central banks, they have no other choice but to comply with our fantasy. And this is the reason behind this lunacy, this insanity that we've been seeing since the beginning of the year, not just in US markets, but also and perhaps more specifically in international markets. And it doesn't matter what corporate earnings say. Matter of fact, the worse they are, the better. And the reason is we have financial markets that are still stuck in the drug addict mentality. They've been accustomed for years, if not decades, to become an addict to liquidity from central banks. Because in the era of QT, it didn't matter what you buy. Everybody is a financial genius. Everybody is making money from the stock market, because all what you have to do is put your blindfolds on and bet on a random stock. The lower the profits, the better. And you ride the wave of central banks pumping the stock market by artificial liquidity, printing money out of thin air. And now the market in this mentality looks for any avenue, for any opening, any possibility for the drug to be back, looking for central bank to provide a hit to a market that is suffering from withdrawal. And unfortunately, the messaging from central banks is allowing this addict mentality. Take, for example, what happened today from the ECB raising rates by 50 basis points. Matter of fact, Madame Lagarde struck a hawkish tone by saying in the next meeting, she'll do another 50 basis points. And guess what happened? German bonds collapsed immediately, as if the market's saying, we don't believe you. We don't believe a word you're saying. Then came Andrew Bailey from the Bank of England also saying that we have a long way to go in this tightening program after initiating 50 basis points worth of hikes before inflation goes down. Well, that sounds hawkish. It tells the market that, hey, don't depend on us to pump you higher again because the job is not done. The problem is these central banks, as we've seen with Jerome Powell yesterday, they talk with both sides of the mouth. Andrew Bailey says, yeah, we're raising by 50 basis points, but we now see the recession much shallower than feared. In other words, we're just bluffing about another 50 basis points because the recession is no longer here. We have a soft landing. We have inflation cooling off. No need for more interest rate hikes. And of course, financial markets, be it in England, be it in Europe, be it in Japan, be it here in the United States, they look at this weakness and mixed messaging by central banks and they sniff an opening that, they're just bluffing. They're going to add liquidity back in. They're going to cut rates. So we have to get ahead of the move and start buying now. And on top of that, take insane risk. Absolute lunacy, which is, by the way, more evidence that the underlying conditions for inflation are still here. And the moment central banks pivot, we will see a revival of inflation worldwide. Take, for example, what happened today in the morning here in the United States. We got the news that Bed Bath & Beyond missed interest rates payments, meaning that the company is on the brink of bankruptcy. But guess what happened? The brainless zombie market participants, they saw this as an opportunity to go and buy the stock. And immediately upon this news, bankruptcy optimism, Bed Bath & Beyond shot up higher by almost 25%. Now look me in the eyes straight, and you tell me with a straight face that this is a healthy new bull market. I'll smack you right in the face. You know why? Because this is not a healthy market. This is not a bull market. This is a stupidity rally. We have seen many of those before. And they always end in tears. To begin with, if you're betting that this is a new bull market, you gotta have a reason. You gotta have a thesis behind stampeding and buying the companies with the shittiest earnings, deteriorating revenues, deteriorating margins across the board. If you're buying them right now and you're telling me that this is the bottom and this is a new bull market, and this is it, then you should be betting that these earnings that we're getting from these companies will improve in the future. How the hell would these earnings improve when we have consumer savings getting absolutely annihilated by inflation? And by the way, credit cards being maxed like we have never seen before. How do you think these corporate earnings will improve? If you're buying right now and you're telling me, in the next quarter, earnings will be better, revenues will be higher, you gotta buy now. Where do you think corporate revenues come from? The answer is the consumer. With the consumer getting annihilated, we're not gonna be able to print corporate revenues and earnings anymore. So again, the question is, what is your reasoning behind saying that this is a new bull market? What is the reasoning behind saying that this is a buying opportunity and not just another stupid brain brainless zombie rally. You have no reasoning. Your only reason is the addict mentality of, oh, the Fed is going to provide us with drugs again. Well, guess what? The Fed cannot print corporate earnings. It all depends on the consumer, and the consumer is getting annihilated out there. They're living paycheck to paycheck. They're living beyond their means. They're underwater, and the only thing keeping them alive right now is swiping those credit cards up and down, up and down, up and down, and then get the paycheck next month and pay the credit card. Lather, rinse, repeat. What happens when that chain gets broken? What happens when the consumers start to lose their jobs and they can no longer pay the credit cards? Where do you think these corporate earnings will come from? But unfortunately, perhaps fortunately, in a day like yesterday when the Federal Reserve Chairman Jerome Powell came out and pretty much performed his weakest act ever and pretty much told the stock market that, hey, I'm not going to stand in your way. I think the job is over. I think inflation is dead. We are in disinflation. And oh, by the way, we have a soft landing coming. But I have to say that I got to do these ongoing rates. But it is bullshit. You guys know. So go ahead and buy Carvana. Buy a company on the verge of bankruptcy. Put all your saving in it. And in a day like yesterday, when the majority of rational market participants were expecting the Fed to put an end to this mania and steer the market back to rationale and reality, instead, the Fed steered the market toward more insanity. And that, of course, caused a lot of bears, a lot of folks who are cautious about the stock market and the economy to start to capitulate. A lot of bears yesterday said, okay, I can't take it anymore. I got to take a break. Maybe I'm wrong here. And they started to capitulate one by one. For example, the big short Michael Burry, after saying, hey, sell, which he's right about, by the way, but not right away. And of course, as soon as the market rallied higher in the aftermath of the pathetic performance by Jerome Powell yesterday, Mr. Burry decided to delete his account on Twitter. I see that as capitulation. I see that as the man getting embarrassed, perhaps needing a mental break, reading the comments, some folks taunting him and attacking him, and many other bears did the same. Many other, not just bears, but rational market participants who've been cautious. They're like, okay, maybe I should buy here. Maybe I'm wrong here to be too cautious and afraid. Maybe the soft landing is coming. Maybe inflation is dead, despite all the data and the facts that we have. For example, today I was watching CNBC, and one of the few bears on the channel is Steve Weiss. And today in the show, he was surrounded with a lot of bulls talking about, oh, we're Meta this, Amazon that, this is going to go to the moon, it's over, the margins, this, blah, blah, blah. And the guy capitulated live on TV. He's like, okay, I'm buying the cues. I'm going to go with it, even though I don't believe it. That's capitulation. The moment I saw that, I'm like, okay, this is coming to an end now. This rally is about to top and reverse. Because one of the classic signs to the end of any mania rally, which we can also call bear market rally, is the bears doubting themselves and starting to capitulate. And oh, by the way, the so-called bulls, not really bulls, the bulls are in energy and the value stocks, let's call them the market pigs, who got slaughtered last year. They start to surface out of their holes. That's another sign. But you know what? It wasn't just Michael Burry and Steve Weiss who capitulated. It was me too. Today on Twitter I said, folks, I stand corrected. The bear market is over. We are in a new, healthy bull market. I highly recommend buying stocks with solid fundamentals such as Carvana, Bed Bath & Beyond, AMC, and Snapchat. The lower the profit, the better. See, I told you folks, I predicted this ahead of time. I told you Carvana is going to pop higher. I told you Bed Bath & Beyond is going to pop higher. But all joking aside, another classic sign to the end of any mania rally is who's the poster boy? Who's the leader of the mania? In this case, it is Carvana, a shitty company on the verge of bankruptcy, but that's good for the zombies. This is exactly the kind of company they're looking for to invest in. But when you see this stock reversing midday, closing at the lows, erasing all of the gains, again, one of the classic signs that this mania is coming to an end. And perhaps another sign you want to look for is, notice how in the last few weeks, the market has been acting as, oh, bad news is good news is good news. Bad news such as the economy deteriorating, leading economic indicators in the toilet, for example. That's good because it means that the Fed will give us more drugs. Now, if we get, let's say, good news, quote unquote, meaning inflationary news, wages moving higher, the mania in the housing market being revived, the market looked at that as, oh, it's not a revival of inflation. It's evidence that we have a soft landing coming. The market wants its cake and eat it too. But a classic sign to the end of the mania is when you start getting bad news, be it bad economic news, such as a deterioration of the economy, or bad news re-inflation, meaning wage inflation moving higher, meaning food inflation moving higher, meaning used cars prices moving higher. When the market finally starts to tune in and take the bad news as bad news and these inflationary news as also bad news, that's also a classic sign that the mania is coming to an end. What do we have tomorrow? We have wage inflation. We have jobs numbers. Now, the market is not going to care about the number of jobs created or whatever imaginary jobs that the cooks at the bureau will give us. Doesn't matter what number they give us. Because if the number is bad, they'll say, hey, look, Jerome Powell is getting what he wanted. And that means that he's going to pivot soon. If the number is too hot, they will say, oh, look at this. This is soft landing. And by the way, now Jerome Powell actually believes in the soft landing. But what if wage inflation goes higher? That's the one you got to watch for. It's the revival of inflation. That is the one that will cause reckoning in the Fed and in financial markets too. Because right now, the bulls in the market, be it actual bulls or pigs, doesn't matter. The argument against them in the last few weeks was, hey folks, you're fighting the Fed. You're fighting the Fed, you're going to lose. After the pathetic performance by Jerome Powell yesterday, they're no longer fighting the Fed. The Fed is actually on their side. Jerome Powell says there is disinflation in the economy. And oh, by the way, we're not seeing a lot of jobs being lost. We have a soft landing. That's my base case, he said. But at the end of the day, you have to ask one question, one important question. Is the Fed really in charge or is it inflation?
I'm in charge.
Do you feel in charge?
Because if inflation makes a comeback, it's over. The Fed is a monkey dancing on the tune of inflation. The Fed is not in charge. The Fed will do whatever inflation tells them to do. If inflation revs higher, forget about it. They have no other choice but to go back and tighten. And all of these fantasies by the market that the Fed will supply us with drugs again, poof, gone. Now, I wish we had a solid Fed president, somebody with the confidence and the strength needed for that position. So we don't have to go through this over and over and over again. For the message to be clear, to get the job done, to save the economy from inflation and restore financial markets back to sanity. But the problem is we have weak Jerome Powell, who's a disgrace to humanity. He gave us inflation, and now he will give us the revival of inflation, and eventually he will give us a massive recession. The worst Fed chairman in history. And what's really pathetic is, what I really don't like is weak men. And Jerome Powell is a weak man. And after he got the thing, he got even weaker. Yesterday, his performance was nothing but pathetic. He could have commanded the economy and the market with confidence, with conviction, being grounded in his stance, explaining exactly what needs to be done, instead of speaking with both sides of the mouth, being afraid to be in one side or the other, and sending mixed signals all over the place. Ladies and gentlemen, Jerome Powell is no Paul Volcker at all. Volker got the job done and saved America from inflation. And at the time, a lot of folks did not understand what he was doing. He was criticized, he was attacked, but he stood his ground and said, who cares? Cry me a river. I'm here to do one job, which is saving America from inflation. And to do the job, there has to be some pain, which, by the way, what Jerome Powell said back in Jackson Hole. But apparently between now and then, he lost his balls. Listen to the contrast between Paul Volcker and Jerome Powell. Take a look.
Volker, who headed the Federal Reserve in the 1980s during the Carter and Reagan presidencies, knows about resistance.
What's happening here? When was this?
Oh, this would have been when I was chairman of the Federal Reserve and interest rates were 20%.
Yeah.
And the criticisms was coming in.
He pushed interest rates above 20% to conquer inflation, and succeeded. But Volker had to take the country into recession to do it.
There's a lot of people that just aren't making it.
And the move provoked the most widespread protests in the Fed's history. Angry farmers blockaded the Fed with their tractors.
Was that a tough time?
Well, yeah. Yeah, I think it's fair to say that was a difficult time.
3 decades later, he's under attack again, this time from the banks.
Some CEOs have been particularly critical of you.
Well, I wasn't aware of that. That amazes me. Are you telling me that? No.
Jamie Dimon, the head of J.P. Morgan Chase, said Paul Volcker, by his own admission, has said he doesn't understand capital markets. He has proven that to me.
Well, unfortunately, I think that they proved some of that to me, too. Their own misunderstanding. How did they get in so much trouble?
Now, if Paul Volcker was handling this crisis right now, he would have told us clearly, we got a problem, folks. To get the job done, we have to endure some pain. If the politicians, if the Wall Streeters want to bark at me, good, let them bark. The louder, the better. I'm going to get the job done. Maybe you're not going to understand me right away, but years from now, you're going to thank me. You're going to look back and say, thank you. It's exactly the same way we look at Volcker right now, as a legendary figure. figure. Jerome Powell is a pathetic figure. A solid chairman of the Fed will look the American people in the eye and say, look, the insanity that has been going on for the last decade or so has to stop because it is unsustainable. And to stop it right now, yes, there is going to be a lot of pain. And I understand it's not fair. Up. We panicked due to the thing and unleashed the tsunami of liquidity, which benefited the rich. It's going to hurt the poor and the middle class. I know that, but we got to fix the job once and for all. We got to normalize interest rates. The free money stupidity has to end. People have to live within their own means. And oh, by the way, our country needs to get back to financial sanity. And we got to do it right now, today, as soon as possible. Because the longer we wait, the more pain we have to endure. We have a country with over $30 trillion in debt. We have a budget deficit north of $1 trillion. If this continues, ladies and gentlemen, your taxes will go to 80-90%. If this continues and we continue to kick the can down the road, a few years from now, the debt will increase to $50 billion. And in that case, if inflation rips higher, we're not going to be able to kick the can down the road anymore. We have to handle it at that time, and by that time, with over $50 trillion in debt, and oh, by the way, interest rates rising higher, north of 10%, what do you think will happen? Raising your taxes to 90% will not do it. The entire country is going to collapse. America right now has $31 trillion in debt, and even with the mere increase in interest rates to 5%, we're not even at 5, by the way. We are paying in interest alone $500 billion. This problem has to be fixed now, regardless of the pain that we all have to endure. But unfortunately, once again, we have brainless zombies at the Fed, and we have brainless zombies in financial markets too. But the stagflationary force will wake them all up in a rude way. When we talk about stagflation in the economy, look for example at the ISM manufacturing new orders and employment components. And this is provided by Lizanne Saunders. Thank you so much. You're doing the job for me because I'm too lazy to do it. But anyways, you look at this, it is the lowest and most negative since 1980. Look at me with a straight face and tell me that this is an economy heading into a soft landing. This is the recession part of stagflation. This is the stagnation part. We will look at the inflation part of stagflation. Look at this. A strong bounce for U.S. auto sales in January. This is the highest level since May 2021. In other words, we're seeing a rebound in inflation here. The moment interest rates go down, we see a stampede in buying cars, in buying houses. And the reason is we have the psychology, the inflationary psychology among the consumer. Maybe they're getting weaker. Maybe their savings are getting eroded. Maybe they're maxing out the credit cards. But their expectations right now for more and more inflation to come and higher interest rates to come. Therefore, the moment they see a dip in interest rates, a dip in prices, they see this as an opportunity to stampede and buy these cars, buy these homes, because it is better to buy now than later, where perhaps rates are going to move higher or prices are going to move higher again. We have inflationary psychology embedded in the economy right now. But the chairman of the Fed, the madman that he is, he says we have a disinflation process. And forget about the market fighting the Fed anymore. This is the market fighting reality. This is the market fighting its inevitable destination. And this cannot be illustrated any better than this. We have ISM new orders components in blue, which is, by the way, dropping like a stone, indicating weakness in the economy. Yet we have a good degree of correlation between this index and the S&P 500. But now we see a divergence. As you can see in orange, the S&P 500 moving higher again. Yet we continue to see the ISM new orders component deteriorating and moving down. One of these two is lying. Is it really the actual macro data from the economy? Because this is not the only piece of data suggesting that we're seeing massive deterioration in the economy. Or is it the market fighting reality and fighting its inevitable destination? Let me know in the comments and provide me with some reasoning. Why do you think, oh, it's the macro data that is lagging and lying and the market is right, or vice versa? Participate in the conversation below. But with this commentary out of the way, let's move on and cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average was negative today by 39.02 points, or a decline of 0.11%. On the other hand, the Nasdaq continues to lead the party, up by 384.5 points, or a gain of 3.25%. The S&P 500 also positive by 60.55 points, or a gain of 1.47%. When we look at the sector's performances today, number 1 capturing the gold medal, communication services aka Meta, and at number 2 for the silver, technology, number 3 for the bronze, cyclicals. We have risk on once again, this time around courtesy of Jerome Powell. And the laggards of the day, this is really important, energy, materials, and defensives. Now defensives is where the opportunity is if you're an investor. But they're dumping defensives for now. They're actually rotating out of defensives, out of energy to chase the rally in technology. Big mistake. Where is the earnings growth? Is it in technology? No, it's not. Look at Apple, look at Amazon, look at Microsoft. Or is it in energy and consumer defensives? The answer is clear. Earnings growth is in energy and consumer defensives. But there is no love for these right now because number one, they're risk off, they're not risk on. So everybody wants to chase the mania right now because of FOMO. But another important indicator in the performances today, what about the dollar? Did the dollar play dead yesterday? Did it play possum? Because energy says yes. Energy is moving down. Materials moving down, saying watch out, the dollar is going to move higher. But the message did not sink in for technology yet, for the multinationals yet. These are the kind of companies, the chip names, the big tech names that get hurt the most by the dollar moving higher. So who's lying here? I think the answer is clear. We're going to continue this conversation in the heat map analysis and the charts analysis. But before we do that, how about the market breadth? We start with the NYSE, 63% advancing versus 36% declining. The Nasdaq, 70% advancing versus 27% declining. On to commodities. We know that the dollar popped higher big time, almost erasing all of the losses from yesterday's session in the aftermath of the FOMC. In other words, when we talk about who was lying, who was bluffing, was it gold, was it energy? The answer is energy was right. Energy moved down because energy said, watch out, the dollar should be moving higher. Whatever knee-jerk reaction that we got yesterday, not gonna stick. And so did copper. But gold and other metals were moving higher. Now gold is moving down big. Energy moving down further. Copper continues to go down. So these commodities indicators right now are saying, watch out, the dollar is gonna move higher, which is not gonna be good for the equities market, folks. In the meantime, we have some strong demand here in certain commodities, such as sugar, for example, continues to move higher. Coffee continues to rebound. OJ continues to blast higher. Gains of about 6% for the day. Cotton also moved higher by about 1% for the day. We see meats moving higher, such as lean hogs futures with gains north of 2% for the day. Soybean meal futures and grains also scoring gains worth about 1.5%. So we continue to see demand for these commodities, whether that's being related to China reopening or the geniuses and central banks saying, hey, we're not going to see a recession. The economy is going to have a soft landing, or it's going to also expand and accelerate when inflation is dead. What does that mean? More demand for commodities, which also means more inflation. Can you imagine how high commodities are going to go if the dollar continues to go down? The Fed cannot afford to let the dollar continues to go down. So my expectations are when the zombies from the Fed start to speak, we have Daly tomorrow from San Francisco. Next week, we have the demon from Minneapolis, Neil Kashkari, and the rest of them. I expect them to try to prop up the dollar higher because that is their best insurance policy against inflation. If the dollar continues to move higher, no need to increase interest rates anymore. But they're not going to tell you that. So when a lot of you say, hey, Maverick, the Fed can no longer afford to increase interest rates higher, look at the debt, look at the interest payments that we have to pay. Sure, the other avenue is propping up the dollar. But propping up the dollar will annihilate corporate earnings even more. So keep that in mind. On to options, the big casino. What do we see here? Another classic sign to the end of the mania rally. What is that sign? Spike in the volume of options, but specifically the volume of call options. The ratios get really distorted toward calls, and the reason is we have the Johnny-come-latelys, the poor souls, who hop into the rally after the Fed comes out, and of course the poor souls among the bear community who capitulated and bought the stock market today. Pies in the face, nice and warm. Look at the volume, for example, at number one, Amazon, the hottest stable by far at around 1.5 million contracts traded today. And look at this, about 70.5% of the volume was for calls. And at number two, Tesla, the souffle, with around 1.4 million contracts traded today. And look at this, once again, about 63% of the volume calls, not puts. Apple at number three, with around 1.1 million contracts traded today, 61% of the volume calls, not puts. Classic signs that we're seeing the Johnny-come-latelys, the mom and pops, the capitulating bears, buying call options last minute, and then what happens? The people who bought in the beginning, they start dumping now. They get their profits, and they leave the Johnny-come-latelys holding the bag. And therefore, the classic saying in bear market rallies, you want to be inactive as much as you can, and then become more active on the pullbacks and the drops. Anyhow, what about the unusual activities that took place in the options market today? And we begin with the ticker ARKKKKK for Tesla, which Cathy Wood. She's having a good year so far, maybe deservingly so, because last year she got absolutely annihilated. But don't tell Mama Kathy, it's about to turn around, and it's about to get uglier for her and her scam ETFs. Anyways, somebody's betting on the continuation of the rally for Are Capitulating, and they bought the $50 calls for the expiration date, February 24th, with expectations. The name could shoot up higher and gain more than 12.5% by then. They paid around 55 cents a piece standard. This trade, all in all, spending around $850,000. And then what about the ticker ARKG, which is another garbage ETF that Mama Kathy packaged for you? A winner year to date, of course. A loser if you zoom out a little bit out of the chart. But somebody sees the rally coming to an end and moving down from this point on. And they bought the 32 puts for the expiration date, March 17th, with expectations that the ARKG will move down and lose more than 12% of its value by then. They paid around 80 cents a piece standard. This trade, all in all, spending around $800,000. And last but not least, what about the ticker AIG, which is a classic insurance company, was popular back in the fraud of 2008, 2009. We bailed them out, of course, but they're not doing so hot so year to date, down about 6% or so, and somebody sees more declines to come for AIG. They bought the 52.5 puts for the expiration date, April 21st, with expectations that the name could move down and lose more than 11% of its value by then. They paid around 80 cents a piece standard. This trade, all in all, spending around $800,000. Moving on to the heat map analysis, what do we see here? Once again, risk on, dump the good names, the names with actual fundamentals, and chase the names with deteriorating fundamentals, because all the Fed is going to supply us with more stuff to get high on. When will the message sink in? My hunch is we got some bad earnings so far from Meta, from Microsoft, from Apple, from Amazon, from Google. You can see the trend moving down. These are giant companies. They've never experienced this kind of deterioration in the top and bottom lines for years. But for now, the market is brushing it off because they say, oh, the Fed is going to do this and do that. The problem is, when we get another piece of data suggesting that inflation is rebounding, a definitive sign, then this assumption of, oh, the Fed is going to rescue us, and therefore you have to buy these companies with deteriorating earnings, all of a sudden this assumption goes out of the window, and then we see them rotating back into the companies with cash flow, with solid earnings, with expanding margins. And these companies happen to be in big pharma, the defense contractors, big oil, the refiners, the food packaging companies, the consumer staples, some of the metals companies. But we're not seeing expansion of cash flow, expansion of margins in the reopening names, in the consumer cyclical names, with the consumer weakening. We're not seeing it happen in technology companies, even though there are companies still holding and still producing good numbers. For example, we covered ServiceNow. That was a good report. I'll give it A-. But the problem with this cohort of technology, even for the ones producing good earnings, the valuation is not good. And the Fed right now, the morons that they are, they see disinflation. Wait till they see inflation reviving back up. These are the same people, by the way, who told us that inflation is transitory. Wait till they see inflation moving back higher again. Then they start talking about raising rates, and the market has no other reason but to believe them because they now see the data. They see the revival of inflation. At that point, you cannot excuse these multiples anymore in the technology cohort. So unless you're positive 100% that we have peak rates, the Fed is going to pause, inflation is not going to rebound, unless you have guarantees for these conditions, chasing the rally in technology, specifically the high multiple names, at least for me, I'm not going to do it. I see the opportunity in names with good earnings, good cash flows, and they got dumped either way year to date because we have this stupid rotation. As an investor, this is where I see the opportunity. Now, as a trader, I can play whatever you want me to play. I can buy calls on Amazon, I can buy calls on Tesla, Meta, it doesn't matter. But as an investor, I'm not going to deploy serious cash in buying the dip in Salesforce or Microsoft or Nvidia. These names are still too expensive. You got to have certainty that we have peak rates, peak inflation, and it's not going to come back, and you cannot really guarantee any of that. Anyways, what about the heat map analysis for the ETFs? Again, notice the theme here. We know that the dollar popped higher. We know that oil was not lying yesterday. Oil ETFs, the XLE, XOP, OIH down big. Yesterday, gold fought the move. Gold thought that the dollar is going to continue to move down. Now gold is capitulating, GDX, GLD all down, saying, okay, we get it. The dollar is moving higher. What else? Chinese ETFs, FXI, MCHI, developing emerging markets all down, believing that the dollar is moving higher. Who's for now fighting the move in the dollar? The answer is technology, the XLK, chips, SMH, and real estate, IYR. Now, will those be the next to capitulate if the dollar continues to move higher? That's my hunch. And of course, we know when the dollar moves higher, you gotta go back to value. And therefore, my expectations are, if indeed the Dixie is saying what it's saying right now, that the drop of yesterday was just a knee-jerk reaction aftermath of the FOMC, but the real reaction is higher dollar, then you're gonna see the start of the rotation back into value. What about charts? And we begin with SPY, the S&P 500 30 minutes chart. What do we see here? It's overdone. It's overstretched. Look at the RSI. Look at the MACD indicators. They're all way overbought, quote unquote, meaning we're tapping out here. The rally is running out of gas. The rally needs to go down and invite new blood, assuming we're going to have new blood. But what if we go down in search of new blood, but we're also met with sellers pushing the chart down and they start to stampede to the exit door to capture their profits year to date? If there is a catalyst that will force them to do so. Now I can see earnings after hours, but I doubt it. I can see wage inflation tomorrow. I can see inflation expectations next week. And the big one, of course, the CPI. Now, if we go down by a little bit, let's say 410, 405, that would be the market's behavior looking for more buyers, looking for fresh blood to join the rally, give it the energy it needs to move higher above 416, and of course, above the most important number, 420. The problem is, if that looking for buyers at 410, 405 also panics the holders and they start selling, then we start to flush down all the way to 398. But even if that happens, the beauty of this rally is there's plenty of cushion being built here. So even if the chart goes all the way down to 398, that could be just a pullback, and then higher we go again. So keep that in mind. The actual reversal that will create a lower low in the charts, that's not going to happen right now. That requires a major fundamental catalyst, such as a clear sign that inflation is moving way out of control, reviving higher, and we need to push the economy into a recession by increasing rates more aggressively north of 6%, for example. It's going to require a lot more. For now, all what we're looking for is a pullback. What about the daily chart for the continuous contract for the S&P? It did close above the important resistance, now support at 4,232. Now, of course, the chart is eyeing 4,300. It has the energy in the RSI and the MACD indicators. There is still plenty of room if the chart wants to go all the way to 4,300. The problem is, on the short-term charts, it is getting way overextended. And actually, the bullish scenario would be for the chart to pull back all the way, retest to 4,100, and then find support and moves higher again. But after doing that, the overbought conditions in the daily, the 30 minutes, the hourly, all of that will be fixed. On the other hand, if the chart blasts all the way in one shot to 4,300, even the daily chart will become overbought. Even the weekly will start to become overbought. And that will trigger selling, be it by the human beings or the robots, the algos. And these kind of pullbacks are really steep. My hunch for now is we're not going to go to 4,300 right away. We're going to have a pullback, a retest to 4,100, and then take it from there. Because when we look at the SPX, the cash index for the SPY, we're so close to close the gap right now. 4,228.5. We just need another 1%. We can do that tomorrow. The problem is looking at earnings after hours, looking at the employment report we're about to get tomorrow, maybe we have to close the gap below before rebounding and closing the gap above. But of course, if you happen to be a bear, a legitimate bear, you really want them to close the gap right away. Just get the daily chart overbought, overextended already. Because it's one thing when you have the 30 minutes chart, for example, overextended, all what you're going to get from that is a pullback. But if the daily gets overextended, if the weekly gets overextended, then you get these kind of reversals, a change of trend. This is what the bears are looking for. What about the Qs? 30 minutes chart, what do we see here? Also overextended. And the most important thing here, we have two important numbers, folks. Some of these numbers act like magic. Some of these numbers live in infamy. What I'm talking about is 420 on the SPY and 313 in the Qs. Anybody remembers Mrs. 313? Old viewers of the channel know the reference exactly. 313 is a notorious gravity point in the Qs chart. You can't pass above it easily, and once you pass above it, it pulls you back. And you can go back in the chart and look at the behavior of the chart around 313 today. And I talked about this on Twitter. I talked about this in Discord. I said 313, that's when you want to pull the trigger because they're not going to make it. The Qs will not make it above 313 easily. Now, it ticked a little above 313 and then immediately it got a flush down, sort of the climax of buying that we were talking about yesterday. So the assumption for now is we got Apple weaker after hours. We got Amazon weaker after hours. We got Microsoft weaker after hours. We got Alphabet weaker after hours, so the assumption is the support of 308.55, that will be lost right away in the morning. Now, are we going to go all the way down to close the gap at 300.72? It's going to require the employment report to give us a bump, and this bump should be the wage inflation number. Otherwise, my assumption is the chart is going to gap below. It's going to open below 308.55. But then comes the test. Are we going to see the dip buyers jumping in and buying right away? That will be confirmation that we're not done yet. And whatever wage inflation we got, that's not going to seal the deal. And the assumption becomes dip buying continues all the way till closing the gaps above that we talked about in the weekly charts. But what if the chart gaps down, then the sentiment changes, and we see a continuation of the selling all the way till the chart goes down, closing the gap at 300.72, for example? That would be an ominous sign. That would be not just a technical reversal, but also a shift in sentiment. If that is the case, the next week we could be down at 294.33, if not 290. But even if that happens, folks, the chart remains positive. The chart built a lot of cushion in this rally. And this is the beauty that the bulls are enjoying right now. That even if we pull back, they still got plenty of cushion here. The only ones getting hurt are the Johnny-come-latelys and the poor souls among the bears who capitulated and jumped in and bought today. Now, here's the daily chart for the continuous contract for the Qs. Above the important number, 12,766, and it almost got another top of a reversal candle, 12,987. Didn't make it there, but if we move higher tomorrow, if we make a higher high, that would be the number I'm looking at. But I doubt we're going to get there right away. Now, mind you, this is a continuous contract chart, yet we have a gap. Now, this chart doesn't like to gap like this. So the assumption is, if we have weakness in the morning due to Apple's earnings, Amazon, Alphabet, and maybe the employment number, then we go down. The chart loses 12,766. It closes the gap. Maybe it goes all the way down in a retest to 12,339. If that is the case, I'll be watching for whether it's going to rebound and close above that number by the week or below it. And better yet, I'm watching 12,207, although after today's pop, that's too far for now. But anything is possible, folks. What I see, the RSI, the MACD indicators, unlike the SPY, they're actually getting really, really overextended. So the pullback is merited here. But the question is, how far will it go? And therefore, I just gave you numbers. I gave you what to watch for in the behavior of the chart, both in this chart and the Q's chart. And now you know. But most importantly, when we zoom in to a 4 hours chart for this continuous contract for the Q's, what do we see here? We have a steep trend line. We have a big divergence from the trend line in the aftermath of the FOMC. We have a bearish engulfing candle. All indicators say that we should go down and retest this trend line right away. And that would be a decline of about 4%, believe it or not, from today's closing. But even if that happens, folks, the trend remains positive. The trend remains bullish until the trend is gone, and most importantly, breaking below one support line below this trend line. Then you get the all clear as a bear that this is reversing and moving down. And here's the NDX, the daily chart for the NASDAQ 100. Yesterday, we've been talking about this gap for a while now, 13,242.90. Now, if we go in one shot to close this gap, and honestly, as a bear, you should be looking for this because the daily chart will become really, really overbought, and this will trigger the algos and the human beings to take profits. And this rally would be about 3.35% from today's closing. But what I'm expecting is a pullback, maybe close the gap below, and then do something like an ABC pattern, even if the chart goes all the way down in a retest to 12,208.39. Then it rebounds higher in a C leg, closing the gap above. And what about the IWM, the Russell 2000 30 minutes chart? What do we see here? It did capture 169.5 as support, and it did retest that line by the end of the day and bounced higher. The problem is it did not close at a higher high. Is it a big deal? Of course not. But could it be a sign for a reverse ABC pattern? If we have weakness in the big names, if the sentiment shifts from risk on to risk off, at least for a day or two, the IWM is not going to do pretty good. And if it loses 169.5 as support, we go down all the way to the next support of 191.5. In other words, by looking at all of these charts, be it the IWM, the Qs, the SPY, there is a good chance that this pullback will erase the entire FOMC rally. And the evidence for that is, look at the Dixie, the dollar index. It pretty much almost erased the entire losses from yesterday's session. If this continues, look at the RSI firming up. Look at the MACD in positive momentum. So if we see the Dixie engulfing yesterday's candle in a bullish engulfing this time around, then the message is clear. Dixie will go higher in a retest to 103 as support, now resistance. We're going to see the indices, SPY, Qs, IWM, erasing the entirety of the aftermath FOMC rally. Keep that in mind. Gold is also finally capitulating to what's going on in the dollar. We see a big engulfing candle, reversal candle, as if gold's saying, okay, enough profits here, we gotta pull back. Let the dollar do its thing here. Maybe we'll pull back all the way to 1895, but my hunch is all the way down to 1842, and then take it from there. If that is the case, what happens to oil? Here's the daily chart for UK oil Brent. Oil has to go all the way in a retest to the trend line. The problem is, if it breaks this trend line, we got a problem. It will not be definitive. It's not going to be it's over, because we have 77 as support, which is an important number. But my hunch is some of that money coming out of gold will chase the dips in oil. So you could see the phenomenon of the dollar moving higher along with oil. Keep that in mind. When it comes to the 10-year yield, what do we see here? We have a double bottom formation. For now, mixed signals. No definitive answer whatsoever. Look at the MACD indicator, for example. It went green yesterday. Now it's red again. We need to see a move above 3.5, and then we can say, okay, yields are going to move higher in a retest to, let's say, 4% once again. And it is a no-brainer. If the dollar moves higher along with yields, not going to be a good outcome for equities. That could be the catalyst for the pullback. But again, let's read the tea leaves here, folks. If Jerome Powell did not do it for the 10-year to move higher, what would be the catalyst? What would do it at this point? The answer is, how about wage inflation coming out really hot tomorrow? And if that is the case, what about the TLT, a daily chart? It is now bumping at 109.5. But could it be a double top? We see a double bottom in the 10-year yield. Could this be a double top here? And therefore, folks, I've been saying I'm not going to chase the TLT unless it closes on weekly basis above 109.5. VIX 4 hours chart, what do we see here? Yesterday, we talked about the phenomenon when the VIX rallies along with the indices. That also signals a reversal coming, a pullback coming. Now, the Dixie just rebounded from 18. It did not close above 20. It needs to close above 20 to say, okay, we have an increase in volatility, which usually comes hand in hand with a reversal of a move in equities. But let's not get ahead of ourselves here and wait for the weekly closing for the VIX. Is it going to be above 20? Is it going to be below? Moving on to the big kahuna, Apple, 30 minutes chart. What do we see here? The name did close above 150, which is also known as the no entry zone. Last year, every time Apple got to 150, we shorted over and over and over again. And that was the right move. And the reason behind that is Apple did not provide any evidence that merits entry above 150. Now ask yourself a question, an important one. After the abysmal report that we got after hours, did Apple provide any legitimate piece of evidence to justify the entry above 150? The answer is absolutely not. Now, if the mania continues, all bets are off. But in a rational market, Apple did not provide enough evidence to trade above 150. It needs to go down. It needs to go back in a retest to 145. Tesla, the souffle, 30 minutes chart, what do we see here? It got all the way to my number, 194.55, and it consolidated. And in the beginning, it was a bull flag consolidation pattern. The problem is, it got really overbought, and it pulled back, erasing the bull flag pattern, indicating weakness. Not enough energy to crack above 194.55. What will do the magic here? What will be the cause for Tesla to move above 194.55? The answer is a stampede on the 200 calls with the expiration date of tomorrow. The problem is, I think they ran out of time. They should have done it today. And if Tesla opens down, let's say to 179, for example, we will see capitulation. Call options holders on the 200 will start closing their call options. This provides feedback to the market maker to start dumping shares of Tesla that they're holding. As a hedge, of course. And that could create a cascading impact where we see Tesla going down to 179, if not 170. On top of that, when we look at the daily chart, what do we have here? We have a spinning top candle, which is a sister candle to the doji candle, which is an indecision candle, meaning the bulls ran really hot but couldn't find the energy to close at the top. And the bears moved it down by a little bit, but they're still hesitant. They're not sure if they should jump in and short the name and push it down. Indecision candles followed by a decision. And for now, when we look at the RSI, when we look at the action after hours, the odds say that the final decision will be in favor of the bears, and we see a negative closing for Tesla tomorrow. And what about Bitcoin? Tulips, what do we see here? It is moving higher, but not decisively so. It needs to get out of this consolidation zone. For now, it's not finding the energy to do that move. Maybe it's going to happen tomorrow, I don't know. But if the dollar continues to move higher, the likelihood becomes Bitcoin moves down, it loses 23,189 as support, and then my outlook for a head and shoulder formation takes place. Too early to say right now, but I'm looking for a loss of 23,189 at least if the dollar continues to rebound. And here's some bonus charts for you. We talked about Amgen today on Discord. Now, I'm looking for a fill of the gap. I wish Amgen would go down and close the gap below, but it's also rebounding from a Fibonacci retracement level. That could be enough. It could continue to move higher from this point on. And the dips in these kind of names are are the ones I'm looking to buy. So my strategy for now, looking at the RSI, way oversold. We got the rebound today. Is it going to continue, not continue? I don't know. But I'd like to buy Amgen at, let's say, 230. So I sold the 230 puts. We have dividends on February 14th. I sold the puts for the expiration date of February 17th. Meaning, if the name pulls all the way down to 230, I get the chance and the option to buy the name at that price. If not, and the confirmation would be if it cracks above the next Fibonacci support/resistance, then I know I'm not going to get that opportunity, and then I have the option to make a decision or not, whether to buy Amgen north of 250 or not. That's the beauty, folks, of using options as an investor. Forget about the gambling, buying calls, buying puts randomly. You can use option strategies to minimize your risk in investing, in opening positions, in exiting positions. And last but not least, what about Coinbase, COIN? Today in Discord, I talked about buying puts against Coinbase. And again, what I see in the 15-minute chart is a head and shoulder formation. The assumption is Coinbase should go down and close the gap at 66. But folks, I'm not going to wait for it to do that because the name is under a massive gamma squeeze. So we could see a gap down in the morning and then we see the dip buyers stampeding right away. So I'm going to close quickly. This is one of those trades of always be closing. So if you followed, keep that in mind. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the non-farm payrolls, but most importantly, the average hourly earning. And then we have the services PMI. And finally, the Fed zombies are going to start speaking now. And we start with the San Francisco Fed President, Mary Daly. Now, in the earnings calendar, we have a name that I own in my portfolio, Regeneron. Let's hope I don't get slaughtered here, but that's about it. With that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again over the weekend. Stay tuned.
Arrogance and stupidity all in the same package. How efficient of you.